Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today. Let's get on it. Earnings review. If you have missed yesterday about TELUS, Rogers, and BCE, I urge you to go back to see what happened with those telcos. But today we're all over the place for this earnings review. So we're going to start with one of my favorite company these days. Well, of course, it's just because I'm making a lot of money on it, but Stantec has been on a roll for a while. Perfect dividend triangle. It's an engineering firm. The ticker is STN. Trading on both the US and the Canadian market, and it has reported another robust quarter. So we're talking about double-digit growth, revenue up 12%, earnings per share up 18%, and the growth was split between 5.6% organic growth and 5.2% by acquisitions. I like when a company is able to provide both organic and grow by acquisition in the same bundle. 1% FX currency positive impact, so that comes and goes, but what management highlighted here is the strong performance in the organic growth for water and energy resources businesses, and they posted a double-digit organic growth for water, high single-digit for energy and resources, and also robust performance from the public infrastructure spending. It has been a while that the company keeps on reporting high single-digit to double-digit growth across the board. And one thing that is even more important with engineering firms is their backlog. The backlog is all the orders that are already registered for the coming months. And the backlog on this quarter was at 8.4 billion. So it's up almost 15% versus last year at the same time. And it represents about 13 months of work. So the company will continue to report great earnings for the next 4 quarters, which is kind of cool. And it gives you a sense of where it's going to go in 2026. Now we're moving into another sector, consumer discretionary, Canadian Tire, CTC.A.TO. This one, I mean, bit of a hit and miss kind of type of quarter. We have like flat revenue sales. We have earnings per share, adjusted earnings per share up by 6.5. The GAAP earnings were actually down 12%. So see how you must put numbers into perspective and not just jump on the gun or say, oh, adjusted EPS, amazing, up high single digit, or oh, it was a really bad quarter because the GAAP earnings were down 12%. So what to understand here? Well, the thing is, the company is investing massively into its True North transformation. So a lot of restructuring charges. Most of the time, they will count that in the GAAP earnings, but they will take it off from the adjusted earnings just to show that it will be a one-time cost and it's not going to be recurrent. So right now, the reality is earnings per share was down 12%, but adjusted, it's a little bit better. What is really important when you look at retailers is more to look at the comparable sales, because you want to know if one store versus last year was growing or not. So in terms of comparable sales, we have CTR at, well, the Canadian Tire stores at 1.8%. We have Sport Check up 2.4%. No, it's not true. 4.2% for Sport Check, sorry guys, and 2.5% for Marks. So at least it's going on the right side for the organic sales. And the other thing that was nice was that it was the first quarter in a while that the discretionary spending, so Canadian Tire is kind of like commenting on like daily purchases that is like a little bit more stable, and then discretionary, which are usually higher tickets or things that you're just going to treat yourself with. It was the first time since 2021 that it was growing, so that was good. Small red flag here, financial services revenue increased only by 0.6% because it was mostly offset by higher write-offs. So again, you have to be a little bit more careful about that in the future. They have credit cards. It's great to retain clients, but if they're not paying, you're kind of missing the point, right? Going on to the software industry, Constellation Software. This company is going down and down and down. It's like the worst year ever for CSU. Ironically, they reported revenue up 16% and earnings per share up 28%. Free cash flow available for shareholders up 46%. And then you're going to tell me, but Mike, how come the stock price goes down? We did an episode with Nelson not too long ago. I was discussing how I love Constellation Software, but the fact that the CEO stepped down for health issues, and there is kind of like a worry about the company not able to continue acquiring small businesses at a good pace to move the needle, plus having competition from AI, small fintech. That's why basically that there's a negative narrative. I'm holding onto my shares. When I see results, they speak a lot louder than narratives. So the numbers are telling me that Constellation Software is doing great. They've done plenty of acquisitions. We're talking about $281 million in payment, and then another deferred payment of like $134. So $415 million in acquisition deals just this quarter. So I don't really see the problem here with Constellation Software. I'm going to hold on to my shares. I'm not even going to bother to look at the stock price, and I'm going to be very happy. Moving on now to CCL Industries, another robust quarter. I'm really happy to have this one in my portfolio. Well-diversified company, doing business across North America, Europe, and Asia. Revenue was up 6%, earnings per share up 11%. So, and what I like is the results were driven by 3.7% of organic growth, a little bit of acquisition, and 2.5% of fixed currency. So everything was running smoothly. The CCL segment was actually up 9.4%. So really good news here. And where it didn't go that well was with Avery's. So the label site, the labels business segment was essentially flat with 2.8% organic sales down. Organic sales down by 2.8%, mostly on tariff headwinds and U.S. sales, but it was offset by acquisitions. So overall, pretty robust quarter once again for CCL Industries that has this habit of usually growing high single-digit to double-digit growth quarter after quarter. I'm going to end up this quick roundup with the rest of the Brookfield family. So not too long ago, I did a mini series of like 3 episodes, and you can actually download the guide at moosemarkets.com/Brookfield to download your free guide on how to understand the Brookfield family. So BAM and BN. Great results. We are talking about earnings per share, distributable earnings per share up 8% for BAM, up 12.5% for Brookfield. So the main difference between BAM and Brookfield is BAM is just getting money from the funds. So they're charging a fee on the funds they receive to manage. And then Brookfield does that, plus they're doing asset recycling. So they're using their own capital, buy assets and STEM, and then sell it afterward. So that explains why the distributable earnings was a little bit higher at Brookfield versus Brookfield Asset Management. Overall, great quarter. They raise their inflows. They're receiving more money to manage. It's going to continue this way. Super happy about the results. So keep in mind, very volatile stocks, but overall, they're pulling out great performances. And finally, we have Brookfield Infrastructure, BIPC, with revenue up 6%, FFO per share up 9%. Most of the growth actually was coming from the midstream at 6.9% up, and the data centers. I mean, AI boom is everywhere. That it's the smallest segment of Brookfield Infrastructure, but it was up by 62%. So now it's like 15% of the business. It started around like 9 or 10% not too long ago, and now it's going up as it grows really fast. The transport segment was down 7%, and then the utilities were up 1%. The company is already on track with the deployment of their capital for the year. They have invested another 1.5 billion throughout the quarter. So they keep on running the same playbook of buying assets, making them better, making them more profitable, and then selling them down the road to create a profit and recycle that money back into the wheel. So, right, Moose, 10 minutes. Wow, that was crazy, right? So, today we covered Stantec, Canadian Tire, Constellation Software, CCL Industries, Brookfield Asset Management, Brookfield Corporation, and Brookfield Infrastructure. If you wonder what is the best time to buy or what to buy, I have a complete investment roadmap. It's kind of like a mini course. It's 100% free. You can register at moosemarkets.com/roadmap. So you're going to get your investment roadmap to have a clear process to buy the right stock for your situation, for your portfolio. So it's moosemarkets.com/roadmap. All right, Moose, that's enough for today. Tomorrow, we are talking about Emera, and we're going to see if it's worth your position in your portfolio. Until then, don't forget to stay invested.